Welcome once again to the Seewing Yee. Thank you for attending. Today's headline for this video is Good Debtors Prison. That's right, you heard me correctly. Before I share my screen, if you see value, please smash the like button and subscribe to my YouTube channel. Finally, please also subscribe your email to my website below so you could become our free member of our real estate investing community. Without further ado, let's dive in. I think you're going to find this short video presentation very intriguing, maybe a bit controversial. We'll see. Here we go. Let me share my screen. Let's get started. You guys heard of debtor's prison, right? I think most of you have. Debtor's prison on a historical basis, it has a pretty negative connotation. It is defined in a general public as people who got into a consumer debt, credit card debts, heavily in debt, student loan, car loans, and consumer debts. But in this particular case, for the purpose of my definition, a mortgage debt is a good debt, is a asset. The low mortgage rate is a loan collateralized by a lucrative asset called the house, the equity on the underlying asset. All right. Just want to make that very clear. So good debtor's prison. What does that mean? We're going to find out. All right. Drying up ripple effect of housing inventory levels. Decades in the making, it will need decades to resolve. Look at the nation's builder, which is a primary construction of new homes for new buyers on a historical basis. Look at this. Single family production, permits falling off a cliff. The housing market continues to weaken due to stubborn high construction costs and elevated interest rates, all harming the housing affordability, according to the National Association of Home Builders. Look at the NAHB's builder confidence. It has dropped off a cliff. So again, because of the high interest rate, the nation's builders are unable to continue with construction of new homes to accommodate the demand in the marketplace. As you can see, the index, the confidence index has fallen 32%. So that is a very troubling trend, to say the least. But wait, there's more. And the other side of the coin, a healthy housing market requires what I call economics 101, demand versus supply. 5 to 6 months of supply of inventory is a healthy market. Right now, we're sitting at a little bit around 3 months inventory of supply of homes, which is very low. It's not going to get any better, especially currently with the mortgage rate as we speak. Now we are entering into March of 2023. The mortgage interest rate, the 30-year rate, is almost at 7% the last time I checked, according to the Mortgage News Daily. I think it's 6.88% or something like that. So it's hovering around 7% benchmark, which is very troubling indeed. However, as you can see, the sellers are locked in. They are in debtors' prison, good debtors' prison. A mortgage debt is good for homeowner because they are locked in at a 30-year fixed rate mortgage on a historical basis, right? Which they refinanced back in 2021, 2 years ago. And look at the homeowners. For those people that own homes over time, look at the massive housing stock, $38 trillion, trillion with a T as in town, okay? And the home equity have surged to over 27 trillion recently due to the skyrocketing of prices. All right. So sellers are locked in. 9 out of 10 mortgages have interest rate below 5%. More than 40% of all the homeowners don't even have a mortgage. Look at the ratio of homeowners equity versus mortgage debt outstanding. Okay. This is on a historical basis. The people that have mortgages on the underlying home that they live in the U.S., especially people that own houses for many years. They have massive amount of wealth, a massive amount of equity, and because they're locked in, and they could be in debtors, mortgage debtors prison, if you will, for a long time to come. Look at the breakdown. Look at 10 million people in this country have a mortgage the rate of less than 5%. Almost 5 million people have mortgage rate, a 30-year fixed rate mortgage of 2.5%. And almost 300,000 people have a 30-year fixed rate mortgage of less than 2%. Look at this breakdown. This is mind-boggling. And throughout the past 8 years, according to Alto's research with respect to single-family homes, as you can see, the level of the inventory has been decreasing consistently, not only from 2015 until now, January 2023, but way before 2015. We see the steady decline of inventory. We need about at least 2 million homes. Right now, we're at barely not even 500,000 currently, and it's getting less and less because of the mortgage rate the way it is right now. So the question we all have to ask is how deprive homeowners of their good debts, how to achieve early release with good behavior from the good debtors prison. Low mortgage rate of 6 to 4% or 6% or more or 4%. Otherwise, these homeowners will remain in good debtors prison for life for 28 more years because they're sitting on a historical 30-year mortgage rate that which we'll never see again. So they are hoarding all those homeowners currently, they're hoarding their mortgages. They're not letting it go. Why should they? They have no motivation. If they're holding a mortgage less than 4% and even at 3%, why would they move up and sell their historical rate, low rate mortgage of 3% to move up to a 7% mortgage? That would be almost doubling the mortgage payment on a house they're going to move up to, which is probably cost more, a lot more than the house they currently have. It just does not make any sense whatsoever. So, are we going to see a multiple offers and bidding wars in pockets of the country? Yes. This spring buyers season, up until now, we're moving into the third month of the year that we are right in the middle of the first quarter of 2023, first quarter. We are seeing pockets of the country where there are a little bit of multiple offers, a little bit of a bidding war, maybe 5 or 10 people offering for one house. And the offerings price typically around 5 to 10% above list price. Nothing crazy like back in 2021 when we're seeing 20, 30, 40% above list price on those crazy times 2 years ago, 2021. All right. So this is a sample over here. I live in San Francisco Bay Area. One of my realtor friends, she just provided me the listings that she had a couple of weeks ago on a couple of these homes, $1.5 million home average. And the final list price was $125,000 above list price. On here, as over here, same thing on these two houses. Just a small sample. But who knows, right? At that time, a few years ago, the mortgage rate were 5.99% or something like that. But in a mere couple of weeks since then, the mortgage rate has jumped up from 5.99% on February the 2nd. Now, a mere almost 1 month later, the mortgage rates have topped up to almost 7%. So time will tell to see what's going to happen. So I'm asking you this question. At 6% mortgage rate, the psychological barrier, for example, even at 5.99%, this is a psychological trigger. If the mortgage rate fall back to 5.99% and will maintain itself, will we see massive appreciation of homes? What about at 5%? Some experts predict mortgage rate could fall to 5 and 5.5% before the 2023 is over. We have a frenzy. What about, let's hypothetically go over the most extreme. What if the mortgage rate has for all the way down to 4%, we could have all hell break loose. To recap, here are the three options for people out there. Continue to sit on the sidelines and time the market. I'm talking about real estate investors and primary home buyers as well. Okay. Or pull the trigger now, since there are little to no competition, and so we're still a little bit of a buyer's market right now in certain markets, but technically we're still in a seller's market, just so you know. And finally, or we personally, I would buy now and get in front of the crowd, get in early before the competition ramps up. So what do you think? Do you think I'm off my rocker to make these kind of comments and make this kind of prediction? Am I just thinking outside the box too much? So please comment below. Let me know what you think. I'll be more than happy to respond to it. So yeah, this is my take on what's going on. Is some of you guys thinking could be a little bit extreme in my thinking. Everybody have their opinion. So here we go. So if you see a lot of value in this video, please smash the like button and subscribe to my YouTube channel. And finally, subscribe your email into our database on my website below. Click on the website, click on the newsletter, and become a free member of our real estate investing community. Thank you so much. This is Seewing Yee. Have a nice day. I will see you on the next video. Bye-bye.